In this video, we're going to talk about technical indicators for beginners. So it's going to be very much an introduction to technical indicators and oscillators. So what we're going to do is we're going to review the moving average, the RSI, and the MACD. And again, this is going to be very much a beginner-friendly video. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader, and I'm at the stage now where I'm studying technical analysis. So if you'd like to download my 6-month blueprint, which outlines everything that I'm doing over the first 6 months of this journey, you can find a link to that below this video. So what we're going to do here, talk about technical indicators and oscillators, and then actually review some. And we're going to actually jump over to TradingView and actually look at some of these indicators on a chart. So you can get access to TradingView for free. There's a link below. Basically, you just sign up for a free account, and then you can use the tool just like I am using it in this video. If you don't actually sign up for a free account, you're going to get this annoying pop-up that comes up all the time. So just go to TradingView and just create a free account with your email, and you can do everything that we're doing in this video. Okay, so technical indicators and oscillators. Now, analysis paralysis, it's a real thing here with learning how to become a day trader. There's a lot of information to learn. And then specifically in that, you can get caught up in like the maze of these technical indicators. So what we want to do here is talk about what they are, how they're used, and then just review 3 popular ones. So this is by no means a full complete guide to these technical indicators that we're going to talk about. You're probably going to want to go out and review them even more, and we're going to create even more information about them. But it's just a good thing to review when we talk about what these indicators are, and then we review some 3 popular ones. I thought that was a good thing to do. Now, I remember hearing from some really successful traders. There certainly is no holy grail indicator. The ones we review now in this video are some popular ones, but when you actually start trading with your own strategy, you might end up using these, you might not. It's always important also to sort of keep it simple with your charts. So we're going to review some technical indicators here, and there are many others, but you probably don't want to get bogged down by using too many of them. And again, here what you want to do is learn about all of them and then find a strategy in the future, and then see which indicators kind of work best with your strategy. But in terms of what a technical indicator even is, basically these are tools that are used in trading to help us analyze past and current price information on a stock or a currency or a security, and we analyze this information to help us predict future price movement. So that is what an indicator is. It's primarily used to assess trends, momentum, volume, and other aspects of a security to help us with our investment decisions, our trading decisions. So essentially, these indicators take the raw data of market prices and volumes and then transform that data into a more digestible and usable form, something that you can see. So there's all these data points, and then there's these mathematical calculations, and they're done. And then you can see these charts, these lines, and these different range points on a chart to help you visually see what is happening with these different data points. And that's going to let you make trading decisions. So in terms of building on this, it's important to just quickly differentiate between just a general indicator and an oscillator. So all oscillators are indicators, but not every type of technical indicator is an oscillator. So we'll get into what an oscillator is and what even oscillation means. You might want to just quickly review that here. So basically, oscillation in simple terms, it's just a fancy way of saying back and forth movement or a fluctuation. So in physics, you might be familiar with just the pendulum that's swinging. That is a classic example. And when we look to technical analysis, these oscillators are basically tools that help us understand when a stock's price might be getting ready to change direction. So they measure how strong the price movement is and whether price is moving quickly or slowly within a defined range. So you can kind of think of these oscillators as momentum. They measure momentum. So, if you want to think of a speedometer in a car that sort of measures how fast you're going, similarly, these oscillators in the stock market, they don't measure speed, but they measure momentum. So that's going to reflect the rate at which a stock price is changing. So by indicating how rapidly prices are moving, oscillators can signal to us whether a price trend is likely to continue or reverse, and that's going to help you make your trading decision. So that's what an oscillator does in terms of technical analysis. So in terms of how they work, they usually work within a range, and you'll get sort of a high signal and a low signal. So the range is usually just like 0 to 100. So if the oscillator is showing that something is on a range of 100, that is an extreme, and that might mean something is overbought and the price might be coming down. And then on the other spectrum, if you're near 0, that could indicate that something is oversold and it might be a good time to buy. So oscillators, they are very important because they help us traders determine the optimal times to buy or sell based on the underlying momentum in the market. So just like using a thermometer to sort of gauge the temperature before heading out, traders use oscillators to sort of feel the pulse of the market dynamics. And this guidance helps in making informed decision, predicting when a trend is likely to continue or when it is likely to reverse. So when and why are these oscillators and indicators used? Basically, most commonly for trend confirmation. So these indicators can help you confirm that the market trend is either going up or going down. They can also signal trading opportunities. So certain patterns in the indicators can suggest optimal moments to enter and exit various trades. And then they can help you sort of reduce risk as well by providing objective data and objective market data conditions rather than you just relying on emotional decision making, which can lead to over trading and losses. So that's sort of why these indicators are used. And then in terms of like how this all fits into technical analysis, if we remember technical analysis, we're using technical analysis for short-term trading. So we're looking at the price action of a stock. So we look at a candlestick chart and we're watching the stock move on a minute-to-minute basis or an hour basis or longer, but we're watching the price action, and that's needed for short-term trading. So the flip side of that is fundamental analysis, where you're going to look at the balance sheet of a company, you're going to look at the management, you're going to look at the outlook that they have for the next year and the products in their pipeline, and you're going to buy and invest in stocks for fundamental reasons. And you will have a longer outlook. You might hold a stock for 3 to 5 years, and your analysis might indicate that a stock is currently undervalued or overvalued. Well, with day trading and short-term trading, we don't really care about any of the fundamentals of the company. That is not influencing the stock on a day-by-day basis. We look at the price action, what the stock is doing on a daily basis based on the price action, the price movements of the stock. So technical indicators, basically, they will help forecast future price movements based on providing graphical representations and mathematical calculations of market dynamics that aren't readily apparent by just looking at the price chart. So you can look at the price chart, you watch the stock moving up and down, but you can also use these technical indicators and oscillators to help gather all that data that's there within a stock chart based on the price, the volume, momentum, and then create indicators that are going to help you make decisions on when to buy and sell a stock. So that's how these indicators are used in technical analysis. Basically, by using these, we can see patterns and signals that help us understand market movements in a way that the raw data alone cannot provide. So you can't just look at a price chart and see the averages and see any momentum. These tools will help provide data and graphical representations of that data, and that's going to help you make buying and selling decisions. So that's sort of how all these technical tools and oscillators and indicators work with short-term trading. So the first most common one that we're going to look at is a simple moving average. So moving averages It's very popular in technical analysis, and it's used to smooth out the price data over a specific period of time, making it easier to identify the trend and the direction of the trend. So by calculating the average price of a stock over a set number of days, moving averages offer a clear view of whether a stock's price is trending up or down without the distractions or the noise of sort of the day-to-day fluctuation. So we're going to go over to TradingView and actually look at one, but let's just quickly review how these are calculated and how they work. So basically, a simple moving average, it's calculated by averaging the stock's closing prices over a specific period. So if we want to look at a 20-day simple moving average, what you do is you sum up the closing prices of the last 20 days. So you add them all up, you divide by 20, and then you repeat this daily by adding in the new day and subtracting, the last or dropping the oldest day. And you've got a 20-day moving average that sort of just goes on as the stock moves from day to day, and that's going to smooth out any short-term volatility, and it sort of reveals the underlying price trend. So very simple to understand and very simple to see visually on a chart as well. So in terms of using these averages, trend identification is the big one. These moving averages are going to help pinpoint the overall trend. So if a stock price remains above a certain moving average, so say you've got the 50-day moving average on a chart, and the price is currently above that, well, what's that telling you is that the price right now is above what the average has been over the last 50 days. So it's probably in an uptrend. And then if the price was below the 50-day moving average, that might indicate that it is a downtrend because the price now is less than it is or was in the average of the last 50 trading session. So clearly you can identify trends with these moving averages. They can also help you see support and resistance levels. And then in terms of talking strategies, traders can watch and see when some of these moving averages cross over each other. So if you have a 10-day moving average that crosses up over the 20-day moving average, that might indicate that right now in the short term, the prices are rising higher than they were in a longer average period. So could be moving up and to the right. So you've got these simple moving averages, and you also have what are called exponential or weighted moving averages. So a simple moving average, simply it equals, it gives an equal weight to all the data points, whereas these other weighted averages like the exponential moving average and the weighted moving average, they assign more importance to some recent prices. So we're not going to get into the whole math of that, but a simple moving average, it just says, over the last 10 days, you add up the 10-day closing prices, you divide by 10, and that's what you get. Whereas these other moving average, like the exponential and the weighted, they put more emphasis on the recent prices rather than an equal weight on the whole distribution. So again, moving averages, they help you see the average price of a security over a certain period, making it easier to spot trends. So let's jump over to TradingView and we can just get a visual representation of what this indicator is, and how it's a clear example of a good technical indicator. So here we're on TradingView and we're just looking at Apple stock here, and the blue line is the simple 20-day moving average. So it's going to do an average of the past 20 days, and every day it's going to make a new average. And you can see that this blue line is now smoothing out this the stock pattern, the price pattern, and you can kind of see a visual representation of the trend. So if we kind of just look over here, we can see that all these prices are above the 20-day moving average. So that's going to indicate that you are in a uptrend. You can kind of see here we're clearly in an uptrend, whereas here you can see some of these prices now are all below the 20-day average. So the past 20 days, the average price is here in blue, and you can see these prices are below this, indicating that we're in a downtrend. So that's really what that is. Once you get into more strategy, you might be looking at various time frames. This is a 20-day moving average. You can use a 50-day, you can use 200-day, and when you plot several of them on a chart, when some cross over, That could be, a buy or a sell signal for your trading strategy. But that is basically what that is. So in terms of, technical indicators, we're looking at the price chart and we can just choose to put a moving day average. Now we've got a nice visual representation of the stocks, the average price over this time frame. We can use that to make buying and selling decisions. So that's a simple moving average, and it's a very popular technical indicator. So it's worth talking quickly about lagging and leading indicators. So there with that moving average, that is what is called a lagging indicator because it calculates an average of the past prices. So this smooths out the price data, clarifying the trend, which we just saw, but it does not help you predict any new trends. So it relies on historical data. So it's excellent for confirming, ongoing trends because it's based on, real prices in the past history, but it's less effective at spotting the start or the end of these trends. So it's lagging. So the data is lagging what's currently happening in the price action. And then you also have what are called leading indicators. And that's the next one that we're going to review here, the RSI, the relative strength index. And leading indicators, they aim to predict future price movements by identifying early signs of overbought or oversold conditions. So these indicators, these leading indicators, can offer early warnings about potential market reversals, although with these leading indicators, they are susceptible to false signals. So not every leading indicator is going to be completely accurate, or we would all make money every single day. But so they have to be used knowing that you will get some false positives or some false signals, but that is what a leading indicator is supposed to do to help you make price predictions, whereas the lagging indicators use history and historical data to confirm a trend. So moving on, one of the most popular leading indicators is this RSI, relative strength index. So this is an oscillator, and basically what it does is it measures the speed and change of price movements of a stock. So it operates on a scale of 0 to 100, and it helps identify overbought or oversold conditions, suggesting potential price reversals. So this RSI is calculated by comparing an average, the average gains and losses over a specific period. It's usually 14 days. Okay, so how does this RSI work? Well, the calculation is determined by calculating the average price increase. So you take the gains and the average price decrease, and you create a ratio of these averages. And that's known as the relative strength. And then there's a formula that basically allows you to create an index for this ratio, and you can fit it within a range of 0 to 100. So you don't need to worry too much about the formula or how it's calculated, but what it does, it now gives you this range from 0 to 100 that's going to basically interpret the price momentum and the price movements of a stock. So when you interpret these values, you're going to get what is called an overbought condition, or you're going to get an oversold condition. So when this RSI value, so it's within this range, when it's above 70, what that suggests is that the stock might be overbought. So basically what this condition is saying is that the recent gains are disproportionately high compared to any losses during the same period. So essentially, the stock has experienced strong upward momentum without significant pullbacks, making it potentially overvalued or primed for a correction. So that is what this range and this index value is going to say, and what it is supposed to mean. So again, the RSI, it compares the magnitude of recent gains to recent losses, and something that is above 70 within this index indicates that the stock has been gaining significantly, often due to heightened buying activity, which might not be sustainable. So this could lead to investors to anticipate a pullback, as some traders might be taking profits or expecting the rapid price increase likely to slow down or reverse. So this high RSI value, it signals that the upward price momentum is possibly over extended, making it a critical indicator for traders looking to predict potential reversals from recent trends. So that is sort of the theory behind that value. And then when the RSI drops below 30, that indicates that the stock may be oversold. So this condition suggests that the recent losses in the stock are disproportionately high compared to any gains during the same period. That might be signaling that the stock is undervalued, oversold. So again, this 30 level sort of is the benchmark that signals that the stock has been experiencing significant selling pressure, often leading to a downward price push that might be excessive relative to its true value. So let's jump over to TradingView and we can kind of see this technical indicator in action. So here on the stock, we have Apple stock as well here, and we've got the different trends here. And then below that, we've got this first indicator that we're looking at, and this is the RSI. So the range here on the right is 30 to 70, and I've added these circles to areas where we have oversold conditions and overbought conditions based on this index. So anything around 30 is considered oversold, and around 70 is overbought. So the first one here is down here, oversold. And if we look at the actual stock chart, we can see that right after this, a few days after, we are up in an uptrend. So this is indicating that the stock potentially was oversold. The RSI hit around 30, which might be leading into an uptrend in the future. And for this particular example, it worked out well here. And then here we've got an area where the RSI value went above 70, indicating that we might be overbought, and it's followed by a complete downtrend in this particular stock for a few months. And then here again, we've got another good example where we've touched on 30, and then following this oversold indication, the stock has moved in an uptrend from 120 up to 150 in the span of just almost 2 months there. So here's just one example. It certainly does not work perfectly every time, but you can clearly see here with some overbought conditions here, the stock follows a downtrend with an oversold condition here. We're followed by an uptrend, oversold condition followed by an uptrend, and so on. So again, these indicators don't work perfectly every time, but here's a clear example where these indicators certainly have worked in this particular scenario, and that is the indicator on this tool. So it's very easy to see. You just add it to your chart, and then you can have warnings and signals or notifications when something is reaching the oversold level of 30 in this index or overbought area of 70 there. So that is the RSI, and that's just a quick introduction to how that works. So in terms of why you might want to use the RSI, clearly, as we sort of saw in that chart, it can help you identify potential entry and exit points based on the perceived overbought or oversold conditions that RSI index provides. So again, that's sort of what a technical indicator is. It takes that market data, creates that ratio, and then creates a scale. So it's an oscillator from 0 to 100, and that range, when the stock meets those range points, that could be an indication for you to buy or sell or start an entry or an exit point in that particular stock. So just to sum up there, the RSI, you can think of it like a thermometer of the stock market, which measures the speed and change of price movements, helping you identify if a security is overbought or oversold. So that's sort of a quick introduction to the RSI. And now moving on, last one we want to cover here is the MACD. And this one is a little bit more complicated. There's a few more things happening in this one, but it's another good example of what a technical indicator is and how using averages and these different data points can help create a visual representation on a stock chart to help you make decisions for buying or selling. So the MACD, what that stands for is Moving Average Convergence Divergence. So this technical indicator, it's very popular. It seems like it's one of the more popular ones. It helps traders understand market trends. So at its core, the MACD is about comparing two moving averages of the stock price. One that covers a shorter period and then one that covers a longer period. So this comparison helps traders spot changes in the direction and strength of stock prices over time. So observing how these two averages converge. So here's where we get the converge in the name. So by observing how the averages converge, so come together, or where they diverge, where they move apart, this MACD provides clear signals that can guide traders on when to buy and sell a stock. So the MACD is the moving average convergence. So when these averages come together, divergence when they come apart. So let's talk about how it works. And again, we're going to go over to TradingView and actually look at one of these to get a visual representation. Let's go through what the components are, talk about them briefly, and then we'll see a visual representation. So there are really three things that are going on with the MACD indicator. You've got the MACD line itself, then you've got this thing called a signal line, and then you have a histogram. So we're going to talk about these and we're going to see them in action as well. So the MACD line is the foundation of this indicator, and basically it's calculated by subtracting the 26-day exponential moving average of the stock's price from its 12-day exponential moving average. So you take the 12-day moving average and you subtract the 26-day moving average. You're going to get a value that's either going to be positive or negative. So if it's positive, then that generally means that the stock is moving up because the last 12 days on average were higher than the previous 26 days. And if you get a value that's below zero, that just means that currently, in the most recent average of the 12 days, it's less than the previous 26-day average. So you're going to get a value that is negative. So on the indicator, when you view it, you're going to have a zero line that runs through the graph, and you're going to have the trend line or the line sloping and moving above zero and below zero. Now you'll have this thing called a signal line, and what this is, it's a 9-day exponential moving average of the MACD line. So it's acting as a trigger for buy and sell signal. So the signal line is sort of an average of an average. And then you have the histogram, and the histogram simplifies the relationship between the MACD line and the signal line. So it's a visual tool, and we're going to look at it on a stock chart showing the difference between the MACD line and the signal line through bars. So it's a bar chart. And then if the bars are above zero, the MACD line is above the signal line, and that suggests a potential increase in the stock price. And if the bars are below zero, the MACD line is below the signal line, indicates a possible decline. So if we kind of just stop there and just think about that, if the MACD line is above the signal line, then that means that the current momentum of the stock and the price is higher than the average of the 9 days, because that's what that signal line is. It's an average, it's a 9-day moving average of the MACD line. So if the MACD line on the chart is above that, then that's a bullish signal, meaning that stock prices are rising. There's momentum in regards when compared to its 9-day average. And then the histogram is just going to show a visual representation of that with a bar chart. So when we see it, it will make more sense. So let's just talk briefly about what these numbers are, and then the signal line itself and the role of that signal line. And then we'll go over and look at the indicator actually on our chart in TradingView. So you might be wondering, why 12 and 26? Well, these specific numbers are standard in the industry, and they were originally chosen based on the traditional working days in a month, roughly corresponding to 2 weeks and 1 month of trading data. So the 12-day average, it's what's considered faster because it's more responsive to changes, because it's represented with fewer days. And the 26-day might be referred to as slower or smoother because it takes more days in the average, so it's less susceptible to movements based on current price changes. So what does this show? Well, the difference between these two, it gives an immediate visual representation of the trend's momentum. So if the MACD line is above zero, it suggests that the short-term momentum is higher than the long-term momentum. So again, when the MACD line, you take the 12 days and you minus the 26 days. So if you have a positive value, it means that the most recent average is higher than the longer average, meaning that the stock could be rising up. So instead of, doing that calculation yourself in your head or on a spreadsheet, these tools allow you to do that. And then you can visually just see that with a line or a dot on a chart. And that's the power of these technical indicators. You're getting all that data, those averages, you're minusing them off, and then you just instead of doing all those formulas in that calculation, you use this tool and you can visually just see it on a chart. So that's the power of these indicators. And then the signal line, this is essentially a smoother or, also known slower version of the MACD line, being that it's a 9-day exponential moving average of the MACD itself. So it's an average of the average. So it smooths this out. So the role of that signal line, it sort of acts as a trigger for trading signals. So when the MACD line crosses above the signal line, it's typically seen as a bullish signal. And when it crosses below, it's seen as a bearish signal. So we mentioned that, as the MACD line, goes above or crosses through and goes above that 9-day average, it's higher than the past 9 days. Therefore, it's probably in a bullish move. And then conversely, when the faster MACD line crosses the slower line downwards, that could indicate that the momentum or we're going into a down trend. And again, all these signals, when it does this, could be a good buying or selling decisions for someone. So let's jump over to the TradingView chart now, and we can kind of get a visual representation of exactly what we talked about here. So we have our chart here on TradingView. It's the same one that we have been using. And here is the MACD trading indicator. So here we've got the blue line is the MACD line. And then the orange line here is the signal line. And then here we can see these bars are the histogram. So you can see that when the MACD is above the signal line, we've got these visual representation bars are here positive above the 0 line. And then here the MACD line is below the signal line. So the bars here are in red below the 0 and so on. So that's what that histogram is. And then the distance between the MACD line and the signal line shows visually by these bars getting larger or getting smaller. Now, remember what we said, when the MACD crosses the signal line, that is a signal where the stock could be moving in an uptrend. And the first point here, this first circle here, we've got the blue line crossing up the signal line and moving up. And if we sort of just look at that visually on what's happening with the actual stock and the price action, we can see that cross is followed by this uptrend in the stock. And then here we get to a point where, we peak here and then the MACD line reverses and starts coming down and crosses below the signal line now. So remember what that is saying is that the past 9-day average, now the current average, the MACD line, which is the difference between the 12 and the 26-day moving average, it's now fallen below its 9-day average, indicating that you might have a trend reversal. And if we look here at what happens to the actual stock, we hit a high and then we reverse down. Now we're followed from this uptrend, we're followed by this downtrend. So a clear example showing where these signals clearly work in this example. And we've got another one here where the MACD line comes up, crosses the signal line and moves up. And then if you look at the visual of what's happening in the actual price chart, we've got a strong upward trend here in this particular scenario. So again, it doesn't always work every time, but here we can clearly see some visuals where the MACD is rising, crosses the signal line, and we're in an uptrend, crosses down below the signal line, we're in a downtrend, and so on. So that is what it looks like on a chart, what this technical indicator looks like on a chart. And again, all those formulas, taking the 26-day average and minusing it from the 12-day moving average, and then taking the 90 moving average of that and plotting it on a chart, that's what a technical indicator does. It takes all that raw data and then spits it out on a visual representation here. It's much more easier to look at, to understand, and can give you clear signals on when to enter or exit a trade. So I think a good way to sort of summarize this MACD is just talk again about what happens when the lines cross, and then we'll wrap up this video. So again, that MACD line, the dynamics there, that MACD line represents the difference between the two exponential moving averages of the stock's prices. So the 12-day and the 26-day. So when the MACD line crosses above the signal line, it indicates that the 12-day moving average has moved above the 26-day moving average. And this shows the recent prices are rising faster than they were over the longer period. And that signal line, it's the 9-day average of the MACD line. It represents a smoothed out version of these movements. It moves slower because it accumulates this data over a short period of time, but in a more sort of averaged way. And it trails behind the more immediate reactions in the MACD line. But when there's a crossover, when that MACD line crosses above that signal line, as we saw in the chart, it suggests that the recent price momentum is strengthening and moving faster than the average of the recent past, as reflected in that signal line. And this is typically interpreted as a bullish signal, indicating that the prices might continue to rise, and that could be a good time to consider buying. And that's what we saw in that chart when the MACD line crossed over the signal line. So that's the interpretation of the crossover. And again, it's just an interpretation of these data points. It does not happen every single time, but it clearly happens enough that this technical indicator is certainly widely used with a lot of traders. So, why does this MACD line work? Well, this is a helpful tool for traders because it puts together a couple of important trading concepts into one easy to read sort of indicator. And that's really what indicators are meant to do. Essentially, the MACD measures both the direction of the stock's price and the direction that it's heading in and how fast it's moving in that direction. So it does this by comparing the two averages of the stock's prices over different time periods. So the shorter one and the longer one. And the difference between these averages forms this MACD line, which shows if the stock's momentum is increasing or decreasing. Obviously, if it's positive, then the shorter average is getting more momentum than in the past 26 days. And if it's negative, then it means that in the 12 days, it's less than it was in the 26 days. So I think we covered that. And additionally, the MACD uses that signal line, which is a smoothed out version of the MACD line itself and the histogram, and shows the distance between the MACD line and the signal line. That's what those histogram bars did. And this feature helps us see when the stock might be ready for a buy or sell, showing entry and exit signals clearly. So this combination of features makes this MACD indicator very valuable for traders looking to catch and follow trends in the market. So I hope that example, going over that, seeing that example, that visual representation on TradingView, and then having this sort of longer discussion is going to help you understand the MACD, the RSI, and moving averages. But more importantly, this video really is just supposed to help us understand how these technical indicators work with technical analysis and why we need to use them and why we need to study them and master them. And basically, to sum it up, it just takes that raw data out there and has formulas and spits it all together into these visual representations on a chart that we can sort of look at, we can track, and can help us make trading decisions when to buy or when to sell. So I hope that you found this video useful. Subscribe to this channel. We're going to be producing more videos about technical analysis. And again, we're on a journey now. We're in the phase where we're just starting to learn this stuff. If you'd like to download my 6-month blueprint that outlines everything that we're doing in the first 6 months of this journey of becoming a full-time day trader, you can find that link below this video, and I will see you in the next one.